bring in Brian Mulberry, client portfolio manager at Zacks Investment Management, talking a little bit about the big picture and some of these key tech themes. So, Brian, what's most important here? That we get all those cuts priced for next year, or that AI lives up to the expectations?
Well, certainly the market has been pricing in perfection, and that does include interest rates going substantially lower next year. 5 to 6 rate cuts, that means we should end the year around 4%, maybe slightly under, and the market's enjoying a lot of energy and that momentum you've been talking about, because the cost of capital going down means that a lot of these investments into things like AI become that much cheaper, and the road to profitability becomes that much shorter. The problem is, on the other side of that, all of the other sectors haven't necessarily enjoyed the same amount of earnings growth that we've seen from the AI-related stocks, and so earnings per share on the S&P 500 is still relatively flat for the year. So as we approach the close here today with the chance of maybe breaking 4,600, that means that the multiple on the S&P has gone substantially higher, really on the wish or the hope that interest rates go lower. So this kind of sets up the stage for perhaps a little bit of disappointment if we don't get the pivot in monetary policy that the markets have really been pricing in so strongly. There could be some disappointment and pullback in the near future.
What do you think is the breakdown of each theme's driving force for the market? Is it like 60% cuts, 40% AI? Is it 80% cuts, 20? You want to play that game a little bit?
I'll play that game a little bit, and I'll go 70-30. I think it's 70% cuts and 30% AI. The thing about AI right now is, how are you going to monetize it? There's certainly a lot of investment being made on the front end, and that's showing in what you're seeing in the new product releases this week. But it's not yet profitable. There's a few ways to monetize it, but not a ton. And so really the energy behind the lift or the rally in the last couple of months is simply the fact that monetary conditions are easing, financial conditions are easing. You see the 10-year Treasury dropping 100 basis points, and that allows activity to happen a little bit more freely, even without an actual policy pivot from the Fed. That has kind of an insulating effect on policy, though. If we see financial conditions ease on their own, that's really going to keep the higher for longer theme in place, because financial activity starts to pick up as things like car loans get a little bit cheaper. We've seen a drop in 30-year mortgages. That could spur some more activity from the consumer, and we could actually see the Fed have to hold its ground in that higher for longer camp. So until we see a material deterioration in things like consumer spending, or perhaps maybe more job losses than we've expected, that would expect growth to slow down, because really the Fed has been incredibly consistent. They are not going to pull rates back until we get close to that 2% inflation target. So really the model that we're in right now is more people working, they're making more money, and they keep spending it because they have confidence in this economy. Until that picture changes, I don't really see how the market's going to get to 6 rate cuts next year.
You don't think Fed'll do it just because inflation's come down a lot? You think it needs to specifically get there to a 2 handle before they start talking cuts? Because a lot of people are now arguing that the momentum is good enough for them to start slashing before we get to that target. It seems to me that's where the argument is.
Yeah, I think there has to be still progress. If we can get that core PCE number at 3 or lower, then I think you could start to see some of the easing pressure. It doesn't have to happen all at once and then a substantial drop in interest rates again all at once. It could be a little bit more of a stair-step maneuver. The problem is that core PCE number from 3.5 down to 3 is probably going to take a little bit longer than people might expect. Again, with some energy in financial conditions improving, we might actually see prices stick around at their current levels for a little bit longer. So if we do see material changes in that core PCE, we could expect sooner rate cuts. I think that would be true, but we're just simply not there yet.
All right. What's the harm as we wait for that in just parking the money in the high quality tech trades that worked the past year? Because the last month, the market decided to give some of the other laggards a chance, some of the companies that fit junk status, zombie status, high growth but no profitability. Which side of the trade makes sense to you?
Well, we want to follow where the real earnings are, and you can't take anything away from a company like NVIDIA that really did double its revenues in a 12-month period, and they expect to double it again in the next year or so. So you can't take anything away from that. But does that mean there's another 200% rise in the stock price from here over the next year? That's what you would want to be cautious of. I think there's actually still more room and a more common sense valuation in some of the other names like Apple and Microsoft. Microsoft has really the only business model that is monetizing AI right now with its subscription for $30 to bring ChatGPT into its Office suite of products. Now you're having a monetary cycle with AI where we can simply go back and say, how many subscriptions does Microsoft have to sell to recoup its $10 billion initial investment in OpenAI? And then we can go forward from there. A lot of, again, front-end investments in the space. We're starting to see more engagement. I think Google's announcement about Gemini today is going to show you another business model where you can see actual consumers engaging with AI, and allows us as investment managers to go back and say, okay, what does profitability look like? When does it happen? And how long do we have to wait to get there? So I think that there's definitely still energy and momentum in some other names that you can enjoy better performance over the next few quarters than just buying the hottest stock today.
All right. Well said. One of the companies that isn't in the tech category you like, but is about as close to 52-week highs. Want to make sure I get your thoughts on this because I feel like it's been a bit of an unsung hero, is Home Depot. What do you think happens for them if rates stay where they are?
Well, one of the things that we've noticed is that there's a dividing line in the consumer, and that's people who own their home during COVID had an opportunity to refinance their biggest debt, which is usually their mortgage, at 3% or less. That's going to create kind of an anchor situation for consumers where they're going to end up staying in that home for much longer than they naturally would, which creates an opportunity for renovations and upgrades. And obviously that's what Home Depot is really good at. They've put a lot of effort into improving their Pro Series, connecting contractors with consumers to get smaller projects done, but done by licensed professionals. And so as this goes forward, we probably see a slowdown in the turnover of home sales because people are going to be reluctant to give up a 2.5% or a 3% fixed mortgage, especially now that rates are still over 7%. So there's kind of a sneaky upside trade here to Home Depot, just given one of the macro themes that we've been watching.
All right. A pretty good looking chart, about as close, but a pretty crazy V-style volatility just in the last quarter that one would have had to withstand in this. Brian, thanks for the thoughts. Appreciate the enthusiasm and the details. Well thought out. Good stuff.
Thank you.
Absolutely. Brian Mulberry from Zacks Investment Management with the big tech profitability focus. Home Depot in the mix too.